Calculating your mortgage payment as a first-time homebuyer involves several factors, including the loan amount, the interest rate, the loan term, and the property taxes. The first step that you cannot skip is to determine your loan amount and the loan length. The loan amount is the total amount you're borrowing from the lender to be able to purchase the house. This loan amount does not mean how much the home costs, but the loan amount means the typical purchase price of the home minus your down payment. For example, if the potential home costs $350,000 and you're making a 20% down payment, your loan amount would be $280,000, so $350,000 minus $70,000. If you're making a 5% down payment, your loan amount would be $332,500 because $350,000 minus $17,500 equals $332,500. The average loan length is 30 years, but you have other options like 20 or 15 years. These options will help you pay off your loan faster, but will significantly raise your monthly payment. So be sure to determine which one is right for you. After you determine your loan amount, you need to factor in the interest rate. An interest rate on a mortgage loan is the cost you will pay each year to borrow the money expressed as a percentage rate. This number does not reflect any fees or any other charges that you'll need to pay monthly. This rate can vary based on factors like your credit score, your income, your lender, and the market conditions. You can obtain this rate by consulting with lenders or using online tools. Online tools will not be as accurate as consulting with a lender because rates change daily and they fluctuate based on your qualifications. An example to figure out your annual interest rate payment is you have a $350,000 loan and the interest rate is, we'll say 6%. So $350 times 0.06 is $21,000 for the first year, and you split that up into 12 monthly payments. Once you have these numbers, you'll want to consider property taxes and insurance. Along with your mortgage payment, you'll need to pay property taxes and homeowner's insurance. These costs can vary depending on the location, value of your home, and what insurance company you decide to use. You can estimate property taxes by researching the tax rate in the area in which you want to buy. Homeowners insurance costs can be obtained by getting quotes from different insurance companies. I recommend speaking to at least 2 companies. Add both of these monthly costs into your monthly mortgage payment. You want to consider other monthly fees as well, like if a house happens to be located in a neighborhood with an HOA. That could be additional monthly payment of anywhere between $20 a month to $400 or $500 a month, depending on what the HOA entails. If you're purchasing a condo, I've seen it go up to $700 or $800 a month. Private mortgage insurance is another potential monthly fee to factor in. Mortgage insurance is typically required if your down payment is less than 20% of the property value. It is also typically required on FHA and USDA loans if that is one of the loans that you're going to choose from. If you have a conventional loan and your down payment is less than 20%, you will also most likely have this monthly insurance. Something to consider is the less money you put down on a home, the higher the monthly private mortgage insurance will be. This insurance, though, is not a permanent monthly payment. It does drop off after you've paid 20% of the home's value. When you buy a house, the monthly payment you make is more than just for the price of the home. There are a lot of additional items that are both required and not required to pay monthly based on your unique situation. You can use the old-fashioned pen and paper method like this to determine an estimate on what your monthly payments would be, or you could use an online calculator to determine an estimated payment. But if you truly want an accurate number of what you'll be paying monthly, depending on the loan and the house price, you'll need to speak to a lender. If you haven't spoken with a lender yet, do not use a random lender without chatting with them first and making sure they are knowledgeable in your market. They also need to work more than just 9 to 5 on weekdays because real estate is done after those hours. And you want to make sure they're trustworthy. If you don't want to take on the task of finding a lender by yourself, your trusted realtor will have a group of lenders that they can refer to you. Go with your gut on who you choose to work with. As I always say, knowledge is power, and knowledge is saving you a lot of money and making sure that you have no surprises on the largest purchase of your life. If you want to continue to learn, just watch the next video. If you want to ask questions, would maybe like a lender recommendation, or find out what your personalized home buying process would look like, schedule a free 30-minute chat session using the Calendly link in the channel description so you can choose a time best for you to meet up. If you are moving to the Richmond area, let's work together. If you are located elsewhere, I can still help you with your buying process. Don't forget to like and subscribe for more informational videos.